Welcome to Conversations, a weekly audiocast featuring interviews with leading investment strategists and recognized financial professionals. Brought to you by the Market Technicians Association.
This is Conversations, the official MTA podcast series, and today's guest is Bob Prechter. Robert R. Prechter Jr., CMT, began his professional career in 1975 as a technical market specialist with Merrill Lynch Market Analysis Department in New York. He has been publishing the Elliott Wave Theorist, a monthly forecasting publication, since 1979. Currently, he is president of Elliott Wave International, which publishes analysis of global stock, bond, currency, metals, and energy markets. He is also executive director of the Socionomics Institute, a research group. Mr. Prechter has won numerous awards for market timing, including United States Trading Championship, and in 1989 was awarded the Guru of the Decade title by the Financial News Network, which is now CNBC. He has been named one of the premier timers of stock market history by Timer Digest, one of the premier by Timer Digest, the champion market forecaster by Fortune magazine, the world leader in Elliott Wave interpretation by Securities Institute, and the nation's foremost proponent of the Elliott Wave method of forecasting by the New York Times. Mr. Prechter is author, co-author, and/or editor of 13 books, including Elliott Wave Principle, Keys to Market Behavior, Wave Principle of Human Social Behavior, and the New Science of Socionomics, and Conquer the Crash. Mr. Prechter graduated from Yale University in 1971 with a degree in psychology. He served as the 21st president of the Market Technicians Association. Welcome to the program, Bob.
Yeah, great to be here. You make me sound pretty old. We're going way back. I used to be the young guy in the business, and now I've got gray hair.
Oh, you've been serving the technical analysis community for quite a while.
That's a great community. Although, you know, it seems to be shrinking. Back in the 70s, technical analysis got a lot more coverage. When CNBC was FNN, I would say at least 50, probably 60 to 70% of the interviewees were technicians. Of course, these days it's almost all money managers and economists. But I think that trend is changing for the positive.
Do you think it's cyclical? Because in the last, 5 to 8 years, I've been seeing the stats on the MTA website, membership going up, CMT charter holders going up.
Yes, it's definitely, I would call it wave-related. I think the interest in technical analysis, in cycles of social behavior, in unconscious impulses, are all traits of bear market periods. Technical analysis was very popular in the 1930s and 40s. The U.S. government even supported the Foundation for the Study of Cycles in the 40s. That's when books about Elliott Waves came out. Robert Ray's book on Dow theory came out in 1932. There were a lot of books on cycles back then, and then everybody forgot about them in the 50s and 60s. It was all fundamentals. And then the 70s rolled around, and all those things were popular again. And then in the 80s and 90s, people slowly forgot about technical analysis. But ever since the secular trend went bearish in 2000, technical analysis is doing what it should be doing, which is garnering more interest among people as markets go sideways to down. And I don't think that will ever end.
Now, have you always been a contrarian, or was this a learned skill?
I think I was always a technician. I was weaned on Richard Russell's Dow theory letters back in the late 60s and early 70s. I started reading some other newsletters as well. Internal market data, such as the advanced decline statistics and how they would slacken before a top and expand into crash bottoms and that sort of thing, just made intuitive sense to me. And I was surprised, and I am still surprised today, to find so many market technicians still paying what I consider way too much attention to fundamentals. They'll talk about what the Fed is going to do and what interest rates are. If you really study all of the purported fundamental influences on stock prices, you'll find that there are none. People talk about oil shocks. We've gone back and tested the trend of oil prices versus the stock market. Sometimes they're going different directions. Very often they go in the same direction. It fluctuates back and forth. There's no consistent relationship whatsoever. In fact, oil can double and triple, and stocks can double and triple at the same time. The trade deficit has been, economists say, oh, that's bearish for the economy. It's actually been bullish for the economy for 30 years. And every time the trade deficit shrinks, we go into a recession. There are so many different claims about what matters to the stock market in terms of fundamentals, and nobody's really done the research. I think there was one paper by Cutler, Paterba, and Summers in 1989 that looked at news events, and they tried very hard to find relationships, and they concluded that there weren't any. And I think that's the correct conclusion. I think people are wasting their time because fundamentals do not cause the market movement. They are the result of social mood trends, which are moving the market immediately and which move economic numbers with a lag because it takes time to effect decisions made at the same time that people decide to buy and sell stocks. If someone decides to expand or contract his business, it takes a while for him to effect that decision. You have to have meetings, you have to go to the bank and get loans, you might have to increase your inventory, and all those things take a few months, and that's why the economy lags stocks by a few months. So people looking at economic indicators, I think, are 3 months behind the real trend.
Now, I was at a conference a few years ago, and I heard you speak, and by chance, one of your children sat next to me. I'd never thought of you with a family at all, but it got me thinking. How was it growing up in the Prechter house? We had this contrarian, in the family. Going to the grocery store. Can we go through the express lane, Dad? No, we're contrarians. We're going to the long line to check out. We're going through the McDonald's drive-thru. Can we get a Happy Meal? No, we're the Prechters. We're going to get you, what's an unhappy meal? Do you have a bucket of fish heads for my kids? How does being a contrarian, how far do you take it in your day-to-day life?
I try not to be a contrarian for its own sake because I think you can make a lot of bad decisions that way. I mean, sometimes there's a good reason why everybody's lined up in front of, one fish and chips window and not the other. So I say what I try to do is I try to be as independent as possible. The things that do not work for my mind are, for example, arguments from authority. When people say, oh, well, this has got to be true because some person in the know said so, or it's been traditional to think this way forever. That doesn't mean anything to me. And one of the things I think that works for me is that I can take a lot of disparate data and apply induction and come up with generalities about them that I think some people don't necessarily see. And that was one of the insights I think that brought me to socionomics. And my argument is the way that almost everyone is programmed to think about social causality is backwards. And most people look at it as a mechanistic thing so that events come and impact the public mood and if there's a political speech or an economic event or a war breaks out or peace breaks out, that changes the mood of the country. And that's ubiquitous. We haven't found really any other studies other than ours that have challenged that. But having studied the market for so long, seeing the lagging in the fundamentals, I finally realized that there's a causal relationship there, that ways of social mood are moving the stock market immediately and these other things later. So that really it's mood that's the causal and primary force in social change, and it's motivating people to take the social actions that show up later as the so-called fundamentals. So we've got the chronology explained, we've got the causality explained, and it's a very simple and elegant model. And once you start thinking that way, everything in life changes. You read the newspaper differently, you understand politics differently, it's all reactive and late. People try to, for example, they've done many studies on which party is better for the stock market, the Republicans or the Democrats are better for the economy, and that's the kind of mechanical thinking that doesn't work. And all those studies, they try to show a bias, but when you go back a sufficient number of years, you find that there is no bias of one party over the other. So we took the opposite tack, and we spent years doing a statistical study on what happens in elections relative to how the stock market has behaved prior to the election, not after the election, prior to it. And we find out that the stock market for 3 years up to Election Day is the single best indicator among 4 that we tested. The other 3 were economic indicators in predicting whether an incumbent president will win re-election or not. And we took it all the way back 200 years. So it's better than GDP, it's better than unemployment rate, and it's better than the inflation rate. So I think that supports socioeconomic causality. It's the kind of thing that you would never look at if you were the kind that just took ideas on authority. So I would recommend to everyone, think for yourself.
Now, did you have an aha moment where this contrarian mindset linked to your socioeconomic causality development?
Yes, absolutely. In fact, I remember when it was. It was early 1976. I was in Bob Farrell's department at Merrill Lynch. There was a big chart of the Dow Industrial Average and a few other market indicators on the wall. And for some reason, I was thinking of the changes in popular music and the tone and the note ranges and the amount of distortion and harmony and so on. And I had always been struck by the big change around 1965 in the tone of popular music, and I realized, oh, that was a peak in the market. And then I started thinking about the changes since then. You know, by this time it was the mid-70s, and then going back into the 50s, and I started to realize, you know, there seems to be a connection there. And that's when it hit me that the stock market is so much more than just a history of prices. It's a history of waves of social mood, and they have all kinds of other correlations which we've been investigating, and we've started to do statistical studies on. By the way, if anybody's interested in the paper we just finished on predicting elections on this basis, they can go to the Social Science Research Network, SSRN, on the web, and just type in, I don't know, Prechter et al. Elections or something like that. It's in the top 10 downloads right now. And I think it's because we have a whole new take on market causality, but at least I hope that's the reason.
My mentor has a saying that you have to be comfortable being uncomfortable. And you seem to be at your best when sentiment is at 98% bulls or 2% bulls. And that's when you're making your bold market calls. So when the masses feel secure, that's when you feel most confident in the minority. But there has to be a point when you're in agreement with the crowd, probably in a wave 3 portion of the move or in a wave C correction. Are those periods uncomfortable for you?
No, I'm just like your friend. I experience most of the discomfort at the extremes, but I know what they mean, and you can interpret your own discomfort. And the more I feel that, the more I'm sure that I'm right, and the more I press the case. In fact, it was Friday. A couple of the guys I got together, and we were almost excited about the market. It was pushing toward a new high for the year, and every one of our momentum indicators was just screaming it was the end of the move, at least short term. And that's the kind of thing that excites me, you know, when you get to those extremes, when there are 98% bulls in silver, for example, and the world believes it. And another time, of course, was in late February, early March of 2009. By the time we got to 3% bulls on the DSI, that's the Daily Sentiment Index put out by TradeFutures.com, I said, you know, and it's a beautiful 5 waves down under the Elliott model. The momentum indicators were extreme, but they were diverging from the October collapse during 08. So we had everything in place that we needed for a bottom. It actually got to 2% bulls on the bottom day, which was I think it was the 9th of March. And at those times, I'm very excited, but as you and everybody in the business realizes, that's also when the most pressure is on. And when you're early, as I often am, that's when it's the worst, because all the subscribers and everybody else are pounding on you and saying, you know, you're a fool, can't you see what the trend is? So if you can't stand up against that, then you'll never make it in this business. You have to get through the transition period and maintain your opinion, as long as your indicators are telling you what to think.
So you consume large amounts of Pepto-Bismol like the rest of us?
Actually, I don't. It's funny you should say that. I used to have a little bottle of those pills in my drawer, and it's been there for 10 years, and I took it home yesterday, actually, and I gave it to my wife. I said, I never take these. She stocked me up with some meds like aspirin and so on, and I just never need that stuff. Look, the thing that's happening in the markets is that herding is regulating everything. People are herding not only on a long-term basis, and we can show this on all of the indicators of sentiment. It shows every sector of the market. There's no group that's like incredibly wise and always correct. You have individuals herding, getting more bullish when the market goes up, more bearish when it goes down. You have money managers, you have advisors, you have economists. Every single subgroup that we study, options buyers, futures buyers, every one of them herds, and they get more bullish as the market goes up, more bearish as it goes down. We've even found studies that show, to my satisfaction, that herding is fractal. People are herding minute by minute, hour by hour, week by week, and so on, depending on their time frame and the kind of outlook they have on investing. Even people who trade in and out of the very best performing funds end up losing money. When the fund might be up 3 or 4 times, they'll be at a substantial loss because they're always buying the highs and selling the lows and getting scared out. So the only way to have an edge over the market, and I hesitate to say win because that's yet another difficult level, but to have an edge is to try to curb all the impulses to herd. So to answer your question, yeah, there are some times when you're in the middle of a wave and you have to stick with it. But I would say I rarely feel that I'm in complete agreement with the crowd, because even when the market was going down hard in 2008, if you remember, in October and November we had a bottom and the market rallied really hard. We'd only counted 3 waves down, so we knew there was a 5th coming, or we were pretty sure there was. And it was amazing how many people rushed out buys and said, that's the end, this is over with, the bottom is in. So optimism is pretty hard to beat, and the same thing is true of pessimism once you've been through a big bear market. One of my favorite all-time periods in the stock market was September of 1985. The market had just made a new all-time high that summer and had pulled back a small amount, I think about 10%. And the percentage of bulls on the telephone update that one outfit in California had put out was basically 0, but they called me up and said, well, we put in some bulls because you're the only one this week. And that is the power of the old bear market and the memory of that bear market on the herd. That just a little pullback, even after a new all-time high with the market going up, they were willing to say it's over, it's over, it's over. And we were counting it as a series of first and second waves. A third of a third is directly ahead. The crowd's going to start loving the market soon. So we were very bullish, but it just shows you it takes an entire cycle for people to finally believe in the upside, as they did in 1999. And they still haven't let go because that memory is still with them. By the time this bear market finally ends, it'll be the other way around. They'll be skeptical as the market goes up 400 and 500%.
What is something that people would be surprised to know about Bob Prechter?
I drive old cars.
For example?
Let's see now. I'm still driving. I drive 3 used cars. One has 100,000 miles. The other has 200,000, and the other has 300,000. So my wife drives a nice car that she leases, but I'm driving the old ones. I like them.
Are they exotics? Are they poor?
They're maybe a little unusual. I have a full-size van that I bought in 1981. It was a recession year, and the only year that any American car maker, any car maker, had a 10% off offer for full-size vans.
Huh.
So I bought one. I tricked it out, and it's a lot of fun. And in 91, that's about 21 years ago, I bought my wife a convertible Mustang just for fun. And she didn't really like it much, so I ended up driving it. And so I drive that in the summer. And the other one's kind of a utility minivan that she said, I'm never driving that again. It's a mom-mobile. I said, well, I can use it.
That's fun. Looking back on your career, what's something that you would like to go back and change?
Well, if I could change something, it would be I would have liked to have stayed bullish throughout the 90s. which I wasn't. And that was probably the most damage that inherent contrarianism did to my career, because of the historic overvaluation of the market in dividend terms. It exceeded the 1929 valuation, actually, and briefly in 1987, but throughout the 90s was way beyond the expensive level that the stocks had reached at the top minute in 1929. And I just felt that this was not a game I wanted to play. And there have been some pretty good spikes in markets, and I've caught most of the tops. For example, the high in oil, the high in the CRB commodity index, and so on. But I really haven't participated because they've been, in my view, all in the topping area of a grand supercycle, which is the biggest top in the market since the South Sea bubble in 1720. So I haven't wanted to play. I think most people who have played are going to end up losing. I'm sure you've noted that some major hedge funds only in the last 12 to 15 months have had massive losses. I just read one in the paper today that's down over 60%, and these are bullish people. So it's been a very difficult environment because the swings have been so violent. And after oil peaked out, and I put out a very strong message about 3 weeks before oil topped, and I said one of the biggest reversals of all time is directly ahead. It was a fifth wave up in oil. It was taking a parabolic shape. And the darn thing fell, I think it was 78% in just 5 months. And so the risks, as I guess people figured out recently when they bought the Facebook IPO, which I wouldn't have touched with a 10-foot pole, found out. So, you know, we've only had two good buying opportunities since I've been in business. Well, maybe three: late 1974, 1980, 82, and to some degree on an intermediate basis, the first quarter of 2009. Most people in the business, I think, 100 years ago, got to sit through, you know, these 4-year cycles. It would have been great to turn bullish every 2 years and bearish every 2 years and catch all the moves. I think my entire career is going to be one market cycle, from 1974 low to whenever the next bear market bottoms out. That's odd.
Is there a shorter-term market view you can share with us than 40 years?
No, let's not do that. I don't want somebody to listen to this and have me be wrong in a week. But if you really want it, I was pretty strong in the issue that just went out on Friday, which was August the 17th. So if anybody's really curious, they can go take a look.
All right. Well, then I'll follow up with another question in our last few minutes. You're a leader of leaders, but is there anybody that you read that influences you? Is there somebody that you like to read that really piques your interest and makes you go, wow, that's thought-provoking, that gives me pause?
I don't think I'll mention any names because I would hate to leave someone out and have someone be upset about it. But the people that I like, first of all, I don't read anybody. I don't have time anymore. But when I do come across some good material, what I am excited about is someone who lives and breathes the markets and who knows the indicators and the approaches that he or she uses. In other words, are they using cycles or waves or indicators? I want somebody who doesn't just throw one up there like you know, I can't stand oscillators, for example. You know, I don't even need them because I can look at the market and I can tell when there are momentum divergences just by looking at the price trend. But the people who really know their work and have gone back and studied 100 years or more and how their indicators behave in all the past periods so they can intelligently interpret what's going on now, I find that kind of thing very exciting. But I haven't read a mainstream financial magazine or newspaper since the early 90s.
Is there anything you'd like to add before we conclude?
Yeah, just a theoretical point. I think most people mix economics and finance as if they're the same thing. The efficient market hypothesis did that formally and said all the same things that work in the economic marketplace work in the financial marketplace. I think that's 100% wrong. I think that the two fields are entirely different. from the micro level in terms of what part of the brains people are employing when they're in an economic market. In other words, the store where they're buying goods and services versus when they're buying investments. I think they use a different part of their brains, and I think the aggregate result is completely different. In economics, the aggregate result is generally success, and in finance, it's generally failure. And all of these things are interrelated. I wrote a paper with a colleague of mine named Wayne Parker called The Financial Economic Dichotomy. It was published in the Journal of Behavioral Finance in 2007. If anybody's interested in seeing a whole new way of looking at finance as it contrasts with economics, that's the place to look.
Very good. Thank you.
Hey, my pleasure. Great questions.
Today's guest has been Bob Prechter, and that concludes today's MTA podcast. From Lexington Capital, LLC, I'm Lance McDonald, together with recording engineer Shane Skwarek at the MTA, reminding you that price is always right.